Hello and welcome to the MarketNerd. A couple of weeks ago, at the beginning of this month, during our fundamental session, we discussed how current macroeconomic indicators from the US were signaling a stronger US dollar within the market. We discussed the repercussions that it would have for other currencies and the levels that were expected to be reached. We pointed out how the market would be dominated by the dollar reaching higher, and that is exactly what has happened. Now let's go into the charts and see what has happened since. As you can see, the expectations of a reversal in the trend started with the announcement of the new interest rates from the Fed. This happened on July the 27th, but it took a couple of days for that to actually take in. When the new interest rates were announced on the 27th of July, this happened at 8 p.m. Right now we're in the 4-hour time frame, if you can see here. So we're going to move into the 1-hour time frame so we can see it with more detail. And we're going to go back to the 27th of July. So there we are. Here it is. And this is what I'm talking about right now. We can see here that as soon as the news came out at 8 p.m. on the 27th of July, it started an expansionary move to the downside. Now, in order to understand why this happened, we also need to see what was the result of the new interest rates, how much they modify or what they changed there, and how did that reflect within the market. Now, if we go into our economic calendar, we can see that the announcement or the expectations were actually placed on an increase of 75 basis points. But there was also the expectation that the Fed would actually be more aggressive and a little bit more hawkish and probably take the new interest rate higher by 100 basis points, but it didn't happen. So at that point, this announcement was perceived as somewhat dovish, because they didn't actually surpass expectations. And that is what I'm talking about here. This created an expansionary move to the downside. And once this happened, the expectations were placed on the market that there was going to be an overcorrection of this move. But if you see here, it fell short and it didn't really fulfill all that imbalance that was created. So instead, the dollar index reached lower, covering an imbalance that was created in the beginning of July. And to see that, we're going to shrink this down and we're going to see the imbalance that was created here. This was created on the 5th of July. Why did this happen? Well, the US came from being closed. The banks of the US were closed on the 4th of July, and there were some expectations that these moves actually had to happen the week before. But as there was some staggering there, if you can see here, then that was transferred to the next available day for the US banks to be open, and when they actually started trading in. So this is what happened, and then we saw that immediate move that Tuesday. Because it was Monday was the 4th of July, so Tuesday was the 5th. And we saw that since 9 a.m. And it started and it just rallied up and it created the new high, which is a historical high for the US. This is a level that hasn't been reached in about 20 years. And this is what we have seen so far. And so from there, we started a correction there, right? And so we saw, and what we were talking about is what happened on the 27th of July. So going back to that point, we're going to establish the following. First of all, what we see is that during the month of July, we started seeing a lot of indicators that were starting to improve compared to the previous months and their performance. And so this gave us a clue that there was going to be an improvement, there was going to be an improvement in the perception of the US dollar. And this would create the dollar to appreciate again and reach higher. Probably not higher than the key level that we saw on the 14th of July, but close to it, bringing the market into, let's say, a balanced area. When we were talking about this imbalance, as soon as this imbalance was covered, or most of it was covered, as you can see here, a new trend was established, but it didn't last long, right? And why did this happen? Well, the thing is that if you can see here, it reached lower into it. And this is also something that we had anticipated. We had already counted on this happening. And this is where we covered the imbalance from July, right? And so we covered it almost a month later on the 2nd of August. At that point, when we see here, there was an expansionary move to the upside and it lasted just a couple of days before it retraced back down. Now, the reason behind this was the expectations that were placed upon upcoming reports that would allow us to see what the market will do in the following weeks. And we were telling our members how this would actually create a new trend for the US dollar. Now, why was that important? Well, as you know, the dollar is king of the market, so anything that happens here is reflected on other currencies, and these were the expectations that we were placing upon it. One of those reports that was significant was the non-farm payroll, which really surpassed expectations and created an immediate expansionary move to the upside, which also had to be corrected. This is when technical analysis comes into play. By using technical principles, we determine an entry point in order to ride the rest of that move. Now, that announcement of the non-farm payroll happened on the 10th of August, and if you see here, it created an expansionary move to the downside, which wasn't fully corrected, and then it created some retracement. This is when we use our technical analysis here. If we go into lower time frames, we're going to be able to see where our opportunity to enter would have been, and we're able to determine specific areas where we would like price to replay, right? And so we can see here in the 15-minute time frame, I'm not going to go too much into detail when it comes to time frames because this is a short version, but we can see the last order block that we have here, and we can also see this long wick. So most of the times, price will come at least to fill up 50% of this long wick left in a crucial level. And so this is what we see so far. It almost covered it completely and it came really close to the limit of that wick. But if you had enter here and you place your end and you place your stop loss below this, probably a couple of pips below, then you're safe. Once that happens, then you start riding the expansionary move to the upside, which is expected as a correction, first of all, of the imbalance, which is a safe area for you to place your take profits, or a continuation of the move because we were also expecting that the trend of the dollar would shift. And what was that dependent on? Well, it was mostly dependent on both of these reports. First of all, the non-farm payrolls, and second of all, the CPI. And what was the big impact of the CPI? Well, this one provided a shocking result, coming to a 0% increase during the previous month, which was a final signal that even though the Fed will not be as aggressive in the future with interest rates, the economic conditions in the US are improving. And that created another explosive move. And so, like I said, because we were expecting to be a shift in the trend, then we also noticed that there are no more reports that are significant enough in order to create a change within the market. So it is safe to assume that this new trend will take out liquidity pools that were created during the last couple of weeks prior to these expansionary moves that we saw. And we're going to go back into it so that I can reference what we were talking about before. Before these moves happened, we were also talking about pools of liquidity that were created right after this high. And then you can see all these levels and these relatively equal highs, as well as this ones. So all of this had to be taken out. And why would this happen? Well, first of all, when we see that there are liquidity pools or accumulation of stop loss areas in here, this is what most retail traders do, and actually big institutions as well, they place their stop losses above these levels. So what do we see here? Well, first of all, what we said before, we needed to correct this imbalance, then we needed to revisit lower in order to completely correct the market. And we see that there's also two equal lows here, two relatively equal lows here, and that had to be taken out. So it came to completely rebalance this area. But we also left other imbalances that were pending. And then we see the one that was created after the CPI report. Once it failed to fulfill that gap and it created our retracement, then it's safe to assume that this will only collect about 73 to 85% of that move, and then it will shift the trend. And this is what we see clearly here. The motivation behind this move is to bring price to an optimal level, or what we consider premium prices, compared to the previous high that was created on the 14th of July. And this is what we were talking about, which currently stands at 109.29 on the dollar index. Right now, what it did is that it created a retracement, taking out the liquidity pools that we had discussed before, and most likely it will continue in order to come to a key level, which we will have to determine based on our technical knowledge. We'll have to use retracement levels. We will also have to use technical analysis and order blocks that are significant or that are key in order to determine where our entry will be in order to write a retracement of this new expansionary move created. All right, well, that is it for today, guys. I hope you enjoyed this review of the market, and we will continue providing more valuable information for you in the future. Talk to you soon. Take care.